Music streaming giant Spotify has listed on the NYSE for its $1 billion IPO, bypassing the traditional method of raising new capital through Wall Street and heading straight for direct listing. Joining us now from a look at this is from the NASDAQ market site is Santosh Rao, head of research at Manhattan Venture Research. Good to be with you today, Santosh. Thanks so much for coming on this late notice with the news of Spotify. But I want to first understand the structure or the method with which Spotify is coming to the market, not the traditional way. Can you explain this to us?
Yeah, so this is a direct listing where in the traditional IPO, the company places shares with some long-term investors, which is hedge funds and mutual funds, and they do a road show, and then there is a certain price that they give you a price range, and the shares are placed before the IPO. In this case, it's going to be a direct listing where there's no road show. All the existing shareholders can sell their shares to the public. So they're just releasing everything. They're telling their employees and early investors if they want to sell, they can sell. So they're not raising any money. In a traditional IPO, you raise money for your internal operations. Here, they're not raising any new money. Just the existing shareholders will just sell their shares. So that's a big difference.
Okay, so it's a way for the existing shareholders to get out of their positions. But when you don't have an investment bank associated with bringing a company or a deal to the market, you can have a lot of volatility in the opening prices, and you've got price discovery that might happen at a very different price. And you thought, why do you think they're so confident to do it this way?
Yes, that's a big risk because when it comes out, price discovery is a big thing. But I think this case is different. Spotify, for all practical purposes, has been public. They filed their statements in Europe, which they're required to do. So we saw their financials well before. The company is well known. The financials are well known. So it's not a mystery. So the price discovery should not be difficult. The only thing is people may want to know where it's going ahead. I think the history is pretty much out there, has been out there. So I think in that sense, it's not a mystery, like I said. So it won't be that bad. Of course, there will be some volatility initially, but overall, I think as long as the financials are good and the outlook is good, I think the stock will stabilize.
Well, let's talk then a little bit about the fundamental story for Spotify and the metrics that we do know about. What do they look like?
Very good. The revenues are growing at a very strong clip. I think the 3-year CAGR is about 40% coming into exiting 2017 and is expected to grow strong. We follow Spotify, have been following very closely. We think they can do $6 billion in 2018. That's above 20% growth rate. Then overall, I think EBITDA is still a few ways off because they're investing in marketing and other expenses. But overall, the revenues, the key metrics for B2C companies or consumer-facing internet companies is the user growth. We saw that with Snap, which struggled. We saw with other companies which did not show a good growth rate. So here, the user growth is very strong. They have 71 million paying subscribers as opposed to Apple's 30 to 40 million. They have 90 million free users. So about close to 160 million user base, which is a strong base, and it's growing, and it's still untapped. I mean, they're only in 60 countries. There are about 1.2 billion smartphone-enabled, payment-enabled smartphones all over in their 60 countries, and still untapped. Only 14% is penetrated there. So overall, to summarize it, it's totally still under-penetrated market, long runway ahead, strong fundamentals coming into the IPO.
Let's talk, though, about one of the key risks, of course, and that is licensing fees and how much you have to pay the artists. What do we really know about the industry right now as it stands, and who's going to win that game?
Yeah, so I think at this point, that's been the biggest problem. If you can see, I mean, Spotify doesn't really have much expenses, but the biggest expense is the royalty rates. So they pay 70 cents on a dollar to the music labels, and that's been a big limiting factor all along. So I think they are working closely with the music labels. They just renegotiated contracts with the music labels. So I think that should be helpful. But down the road, I think they will have constructive relationships and maybe increase the payout more than 30%. 70%, reduce the payout to less than 70%. So, and I think they're also working with the artists and labels constructively, like I said. So I think overall, I think that things should improve. In the bottom line, streaming services is where it's at. That's the only growth engine for the music industry, and Spotify is the undisputed leader in that space.
What do you pay for a streaming service today?
Well, we'll see where it comes out. Right now, I think 20 billion is not an unreasonable valuation given their size and their growth rate. We'll see where they price the shares and how they come out, where the share price settles. But I think at this point, 20 billion enterprise value is not unreasonable. It can be expected. It can be, I mean, price per share could be anywhere above $100. We'll see where it comes out. It's tough to say. It's tough to say at this point.
Yeah.
But we'll see how many shares are floated. But overall, I think the outlook is good.
And what's the timing of this? Do we know? We must.
Well, historically, when they file their IPO, they take about 20 days to do a road show, and then they do the IPO. But in this case, since it's a direct listing, they may not need that much time. So I expect 1 or 2 weeks they should be out technically. But there's always few things that can delay the things. But I think overall, you can expect in the next 15 to 20 days for them to IPO.
How will you decide whether or not you want to buy this stock?
Well, what I will see is I want to know whether the company can sustain its user growth. That's very important. The investors don't like B2C companies that are not growing in terms of user growth. So I need to see that. I need some commentary there. And then overall, I need to see how they are going to fight against Apple, which they're doing a great job. What's the moat around the business, which I believe is very good. But I need investors, or investors need to get comfortable with the fact that they can maintain their lead. In fact, even though Apple and Amazon are coming right behind them, but they can maintain that lead.
How hard is it going to be to get that information, given the fact that they're not going to do a roadshow? Hence, we won't really have that chatter in the background that people can kind of get from the hedge funds and long onlys and the analyst community, given the fact that they're not going to be out there talking about it. You almost have to wait till it comes out.
Yeah, so you know what's happening, and what really happens with IPO, they get the benefit of doubt. So you have to go with the historical numbers. You have to go what analysts are saying in terms of predictions for the future. So they get the benefit of doubt, and Spotify deserves that. They've been the undisputed leader in this space, in their niche market. So let's see how long the benefit of doubt will stay. The first earnings report right off the gate is very important. They need to show that everything is sustainable. So things like that. So I think in the first blush, they will get the benefit of doubt, and you have to go on some kind of historical track record to see that they will maintain their growth rate.
All right, Santosh, great to be able to catch up with you today. It's going to be one that
Thank you.
everyone's
Thanks for having me.
watching. Thank you so much.